Hi, I'm Mike Bjork and I'm a mortgage planner. I'd like to share a simple financial freedom strategy which one can implement through the use of a mortgage. Now, how we're going to illustrate this is I'm going to show you four different loan scenarios for comparison purposes. Now, the first column, what we're going to do is we're going to utilize a 30-year fix. We're going to estimate the home value is $500,000. We'll take a base loan amount here of $250,000. And let's say today's market interest rate today is at 6%. Now, an amortized payment at 6% would be at $1,499 per month. Now, let's also jump to the second column, which you take the same first as the first column, but we'll increase the loan amount to $300,000. So what we're doing is we're going to borrow $50,000, and that will just increase our monthly payment $300. So now we're paying on a loan balance of $300,000, paying $1,799 per month. Now, a third common another alternative you can do is we can borrow $100,000 out of the from the base loan amount. So we'll have a loan amount of $350,000, and we can utilize a adjustable rate mortgage. In this scenario, I'm going to utilize a 10-1 ARM at an interest only payment, so we're not making any principal payments. And let's assume today's market rate for a 10-1 ARM is 5.75. Again, at interest only, that gives us a monthly payment of $1,677 per month. Now, what most people do to get to that financial freedom point is they like to get themselves into a shorter term fixed rate mortgage. So for illustration purposes, we're going to utilize a 15-year fixed rate. We have a $250,000 base loan amount, and the bank kind of rewards us by giving us a discount of a little bit by. So today's rate, will just say again, market rate would be about 5.75%. So that gives us a monthly payment of $2,076 per month. Now, let's take a look at the savings from the first three columns versus the 15-year fix. Now we have a $2,076 per month payment on the 15-year fix versus $1,499 for the 30 fix in the first column. So that gives us a savings here at $577. Also, with the cash out, we still have a savings of $277 per month on the 30-year fixed cash out. And then on the adjustable rate mortgage with the cash out $100,000, we have a savings of $399. Now let's kind of go to our strategy. What we're going to do here is we can take a look and utilize that differential every single month. Now in the first column, we had $577 differential. We're going to place that money into an investment vehicle, and let's assume today's what we're going to assume is we're going to get 7% rate of return. So at 7%, we can, and with this amortizing payment, we can actually get to a financial freedom point in actually a little bit sooner time. And if you really want to think about it, it's actually a lot safer for you in this case. Why? Because you've actually amortized your payment lower. Now you got the money into an investment vehicle, and now that money in that investment vehicle is actually greater in this time frame than what your mortgage balance is. So in the second column here, what we did is, remember, we start at $50,000, $277 added to the investment vehicle every month, and we're actually able to improve that time a little bit to 14.42 years. Now, the third one, remember, we did interest only payment, but we also start off with $100,000, and then we're adding $399 per month. Now, we actually were able to improve that a bit more. We're actually almost able to improve that from the 15 years to almost 13 years, so 13.08 years. We're actually able to do it, even without having to make any amortized payments on that. Now, another idea is if you really want to supercharge this, you can go with adding your tax deductions on a monthly basis back. So essentially what you're doing is you're kind of paying yourself the refund in the beginning from when after you file your taxes. So in this case, let's assume somebody's in the 25% tax bracket. So with the same scenarios we had above, with the first column, they can estimate $313 back each month on an estimate. And we can add that to our monthly payment on our investment vehicle and exponentially improve our financial freedom point here. Now, look at the difference here. Even though the $100,000 more in balance, the interest only in this case actually will have the same tax deductions year in, year out. So that's one nice advantage by having the interest only payment versus an amortizing where you're decreasing your tax deductions each year in this scenario. Now, one important factor is to keep in mind when you're doing your investment vehicle is you want to make sure this investment vehicle offers a liquidity, you're getting a safety, and you're getting a rate of return. Now, one of the questions I get is, where do I put this money here? Now, to answer that, I'm not a qualified person. I'm not going to tell you where to put your money. But some of my clients, what they've done is they've placed it into life insurance contracts. If you have it carefully constructed, you can actually pull that money out and be able to receive that tax free. And that's the beauty behind life insurance, one of the beauties behind life insurance contracts, as well as having the death benefit, of course. Now, another avenue is you can just open up a non qualified program, and the big, obviously you want to talk to a financial advisor or somebody to help you construct it, because you want to make sure that you're well diversified, but you also want to make sure you have the liquidity and you got the safety and you're getting the rate of return on that. So go apples to apples, you want to make sure that you get a little bit to get the 7% rate of return. And this is figuring after taxes. You will probably want to assume with that one you're going to get about 8.5%. Aim for 8.5% because of the capital gains. Most likely you're going to be paying capital gains on that type of tax on your non-qualified. Now the retirement or qualified program, in this scenario, same thing. You'll be dealing with a financial advisor or somebody who's qualified. In this case, you're probably going to want to go closer to 9.5% because once you start withdrawing that money, most likely you're going to be paying like an earned income on that. So you'll be on most likely a higher tax bracket. Now, the 7% is very doable. You know, the stock market averages higher than this. I've seen life insurance average between 7 and 8% on in some of them. So talk to a qualified person. I'm sure they can get you what you need. But it's not the most important thing. One thing to keep in mind is you also get tax benefits on your interest rate. So uh, in essence, let's say you have that 6% as we used up here, 6% interest rate here. Even if you got a rate of return at 5%, you can actually still make money on that. What? That doesn't make sense. Well, it does if you factor in that 6% that interest rate you have on your mortgage. If you factor after the taxes, it's probably going to be closer to 4.5%. So if you're earning 5% after the tax benefit of the rate of return, you got a 0.5% margin there. I hope you followed me there. So also, some of the benefits by having the money in there in your investment vehicles, you get the tax benefits. You improve your you have the tax benefits. So once you get to the point of retirement, now you have something to deduct because most likely if you have any kids that are on and you have no other deductions but your home. So that's a great thing to have. Another item is liquidity for good times and bad times. We're in a recessionary period. A lot of people are struggling. They're losing jobs. They have no money to tap into, be able to pay their expenses until they get onto their feet. Now you have in your investment vehicle. Also for good times, people are taking advantage of the uh, economy we're having right now, buying homes cheap, buying stocks cheap, taking bargains when they can find them. Again, it usually takes money to be able to take advantage of those situations. So now you have the money to be able to go on with that. And then, of course, you're going to be financially free on paper. And then also the large balance. The compound effect is so great. So now you have, let's say, a couple $100,000. That couple $100,000, that 7% rate of return on that is going to be much better looking to you than when you first began at $0. And let's just take, for example, talking about large numbers. Let's take 7% rate of return on $100,000. That's $7,000 per year. Now, in a million, that's $70,000. Now, you tell me which one you'd like to have. Now, if you, a little tip for you on those who like to play the cash flow from Robert Kiyosaki, if you take a look at columns 2 and 3, remember you're able to actually improve your versus the first and fourth columns. You're actually improving yourself by borrowing more money. Now, how's that? Again, with the the power of compounding interest, you're able to employ that money. Now that money is working for you. By borrowing more money, sometimes you're able to get yourself out of debt much quicker in this scenario. So anyways, I hope that you find this very useful. If you'd like to have something done for you and your family for your personal analysis, feel free to contact me. Have a blessed day. Bye bye.